If you're just getting started with investing, you have probably heard this one piece of advice over and over again. Don't put all your eggs in one basket, right? You're told to diversify, to build this portfolio with a mix of stocks and bonds and all sorts of other things to keep your money safe. And it sounds smart. I mean, it's the bedrock of modern financial advice. But what if that very piece of common knowledge is actually the biggest thing holding you back? What if the safe choice is costing you a fortune in the long run? So that's the big question we're going to tackle in this video. We are going to take a really hard look at that fundamental belief. We'll dig into the data, the logic behind the most common investment strategy out there. Is it possible that the advice that's been dished out by financial advisors for decades is built on a flawed, outdated idea? We're going to explore a different path. It's one that requires a bit more thought, but wow, it has the potential for way better results. And the answer we find might just completely change how you think about building your wealth. Welcome to another video on investment basics. Now, the principles and the data-driven approach we're about to get into come from the incredible work of Mr. Majid Butt. What makes his perspective so unique is his combination of skills. See, as an accountant, he gets the financial health of a company from the inside out. As a software programmer, he can build the tools to crunch just massive amounts of market data. And as a dedicated investment researcher, he's spent years putting these ideas to the test against real historical evidence. So this isn't just some theory. It's a strategy that's born from a deep, analytical, data-first approach to building wealth. And hey, I really encourage you to stick around for the whole video because at the very end, we are going to boil all of this down into 5 super clear, practical rules for success. These are not vague suggestions, okay? These are actionable steps you can use to start building a smarter, more powerful portfolio right away. So here's our roadmap. First, we're going to tackle the asset allocation myth. Gotta understand the old way of thinking. Then, we'll zero in on the biggest weakness in that model, the problem with bonds. Once we get that, we'll introduce the solution, a much simpler, better strategy called the SBI portfolio. From there, we'll get practical and show you exactly how to build one. And then we'll wrap it all up with those 5 crucial rules for success. Sound good? Let's dive in. All right, Section 1, the asset allocation myth. You've heard this term everywhere, right? It's talked about like it's the absolute gospel of smart investing. The whole idea is to mix different investments to play it safe. But today, we're going to ask a tough question. Is it really a strategy for success, or is it just a way to avoid doing the hard work of actually thinking about where your money should go? So what is asset allocation really? Well, at its core, it's that classic advice. Don't put all your eggs in one basket. The theory is that different types of investments, or asset classes, move differently. When stocks are up, maybe bonds are down. The idea is, since you can't predict the winner each year, you should just own a little bit of everything. The goal isn't really to maximize your gains, but more to smooth out the ride and, lower your overall risk. This quote is the perfect way to understand why this strategy might be flawed. Imagine you're at a horse race. Asset allocation is like saying, I have no idea which horse is going to win, so I'm just going to buy a ticket on every single one of them. Now look, you are guaranteed to hold the winning ticket. That part's true. But think about what that really means. The money you win on that one horse is going to be almost completely wiped out by all the money you lost on every other horse. You walk away having broken even, or maybe with a tiny profit. You've protected yourself from losing everything, sure, but you've also guaranteed you'll never have a big win. That's the trade-off. And that gets us to the heart of the problem. Asset allocation isn't a strategy for winning. It's the strategy for not losing badly. It's basically designed to give you an average result. By telling you to own a piece of everything, it actually stops you from asking the most important question of all. Wait a second, is this asset class even worth owning in the first place? It keeps you from using your brain to eliminate the horses in the race that are just slow. And in most portfolios today, there's one particularly slow horse that's dragging the whole thing down. And that brings us to Section 2, the problem with bonds. In pretty much every traditional portfolio, the weak link, the asset class that just consistently underperforms, is fixed income. You know them as bonds. For decades, financial advisors have pushed bonds as the safety part of your portfolio. They're supposed to be the stable anchor in the stormy seas of the stock market. Okay, let's look at the data because it tells a really interesting story. This chart looks at portfolios all the way from 1960 to 1997. Let's talk about one key term, volatility. Just think of it as how bumpy the ride is. High volatility means big swings. Low volatility means a smoother ride. So check out the circle on the top left. That's a 50-50 mix of stocks and bonds. It gave a 9.5% return with a volatility of 10.4%. Now watch this. Move to the middle circle, where we've upped the stocks to 75%. The return jumps to over 10%, but look at the volatility. It's almost exactly the same. You got a better return for the same amount of risk. Now let's go all the way. Top right, 100% stocks. The return is now 11.6%. And yeah, the volatility went up a little bit to 11.8%. But notice how much more the return grew compared to the risk. The takeaway here is crystal clear. Adding bonds just systematically drag down returns without really helping that much with risk. So why did anyone ever think bonds were safe? Well, that idea comes from a much, much earlier time in financial history. But everything changed back in the 1970s when the US Federal Reserve let interest rates float, meaning they could move up and down way more freely. This was a game changer for bonds. See, when interest rates go up, the value of old bonds goes down. All of a sudden, bonds had this whole new level of risk, and they became way more volatile. And as we just saw, their volatility is now much closer to stocks, but the returns are structurally fundamentally lower. You're basically taking on stock-like risk for bond-like returns. And that is a bad deal. So if the old way is broken, what's the alternative? This brings us to Section 3, and the solution we've been building towards, the single best investment, or SBI portfolio. The whole philosophy here is the complete opposite of asset allocation. Instead of owning a little of everything and just hoping for the best, the goal is to thoughtfully build a single, powerful portfolio made up of only high-quality stocks. The idea is to achieve everything you want from investing, safety, income, and growth, but to do it all within one single asset class. That way you avoid holding those underperforming assets. Okay, this table right here, this is where it all clicks. We're comparing a typical asset allocation portfolio on the left with an SBI portfolio on the right. Let's just walk through it. Subaccounts. Asset allocation needs 5 or more, 1 for each bucket. SBI, just 1. Percent yield, the income it kicks off, is higher for the SBI. Now look at the risk numbers. We talked about expected volatility, the bumpiness. They're almost the same, 13 versus 12. And portfolio beta, that just measures how much your portfolio moves with the market. Both are less than 1, meaning they're both less risky than the market overall. And again, they're nearly identical. So the key here is that both portfolios have basically the same amount of risk. But now look at the most important line, percent expected return. It's not even a contest. The SBI portfolio is projected to return 11% a year, while the traditional model is stuck way back at 7.8%. This number, 3.2%, this is the entire argument in one slide. That is the extra return you can expect to earn every single year for taking on the same amount of risk. Now, 3.2% might not sound like a huge number, but let's talk about what it means over a lifetime. If you invest $100,000 for 30 years, that 3.2% difference means your SCI portfolio would be worth over $400,000 more than the traditional portfolio. That is not a small number. That is lifetime-changing money. That's the difference between a pretty good retirement and an incredible one. This is the hidden cost of playing it safe. And the reason this works is actually really simple. When you own a stock, you own a piece of a real business. That business can innovate, it can grow, it can become more valuable. There is no limit to how high a stock can go. But a bond is just a loan. You're the bank. The absolute best case scenario is you get your money back plus a little interest. It can never be worth more than its face value. This is what we call dead money. By getting rid of it, you are letting 100% of your money work for you in assets that have actual potential for long-term growth. So this all sounds great in theory, but theory doesn't pay the bills, right? So in Section 4, we are going to lay out a practical blueprint for how you can actually go about building your own SBI portfolio. This is one of the biggest questions every new investor has. If we're not just buying a fund with hundreds of stocks, how many do we actually need to be safe? Is it 5, 10, 100? What's the magic number? This chart just visualizes the power of diversification so perfectly. So on the left, you've got portfolio volatility, our bumpiness number. And along the bottom, you have the number of stocks you own. Look at the far left. With just one stock, your risk is off the charts. Now watch what happens as you add a second stock, then a third. The risk level plummets. I mean, it's a huge drop. The biggest benefits happen as you go from one stock to about 15. But now look closely at the right side of the chart. Once you get past, say, 15 or 20 stocks, adding more still helps a little, but the benefit is tiny. It gets smaller and smaller. This shows us the sweet spot. You get almost all the benefits of diversification with a number of companies you can actually keep track of. So let's make this real. Here's a sample 16-stock portfolio. Now, don't focus on the specific company names. This is just an example. The key thing to see here is the types of businesses. You've got a utility, which provides electricity. You've got a consumer company that sells stuff people buy no matter what. You've got banks, healthcare, real estate. The things that make a bank do well are totally different from the things that make a healthcare company do well. That's real diversification. It's not owning 16 different tech companies. It's owning 16 different kinds of businesses that operate in different parts of the economy. And managing this whole thing comes down to two simple principles. First, equal weighting. This just means that every stock should be an equal dollar amount in your portfolio. If you have 20 stocks, each one is 5% of the total. This is a super important discipline. It keeps you from getting carried away with one company and betting too much on it. Second is tilting for income. This is how you replace bonds. If you're getting close to retirement and need more income, you don't go buy bonds. Instead, you just tilt your portfolio by choosing more high-quality, dividend-paying stocks that meet the SBI criteria. You get the income you need, but you still own an asset that can grow over time.
All right, we have covered a lot. The theory, the data, the how-to. Now, let's lock it all in with those 5 key rules I promised you at the beginning. These are the things you absolutely need to remember.
Okay, rule number 1. An SBI portfolio replaces asset allocation. It shows nearly identical risk characteristics, but without the performance drag of fixed income. The big idea here is simple. You are not taking on more risk to get those higher returns. You're getting them by cutting out the one asset class, bonds, that is mathematically guaranteed to slow you down. Next, rule number 2. Diversify among as many sectors and industries as you can, as long as each stock qualifies under the SBI rules. This is so important. Real diversification isn't about the number of stocks, it's about the types of stocks. Owning a bank, a utility, and a healthcare company, that's diversification. And rule number 3, try to include at least 15 to 30 positions. This is the sweet spot for achieving diversification without becoming unmanageable. Just like we saw in that chart, this is the range where you get pretty much all the risk reduction benefits, but you can still actually keep up with what you own. Rule number 4. All positions should be at equal dollar weighting. This prevents a single poor performer from having an excessive impact on your results. This is all about discipline. It keeps you from falling in love with one stock and making a huge bet. If one company gets into trouble, it doesn't sink your entire portfolio. And finally, rule number 5. You can tilt the portfolio toward higher current income depending on your needs, using high-yield SBI stocks instead of bonds. This gives you flexibility. The SBI approach isn't rigid. If you need more cash flow, you just focus on high-quality, high-yield stocks instead of bonds. You create your own safety net without sacrificing growth.
So let's end with this thought. We've just spent this whole time seeing how a simpler, more logical approach can actually beat the complicated, accepted wisdom. It really makes you wonder, doesn't it? What other pieces of financial advice have we all just been following blindly that might be holding us back? It's always worth questioning.
And this journey of questioning common knowledge, it doesn't have to stop here. If you found this data-driven approach useful and you want to go even deeper, I invite you to subscribe to the membership. You'll get access to exclusive videos with in-depth investment analysis that you just won't find anywhere else. It's the perfect next step for anyone who's serious about building their wealth on a foundation of logic and evidence. Thanks so much for our time today.